Dear students, welcome to today's class on economics, chapter 1, money and banking. Today's video is all about one of the most exciting and important topics you will learn in class 10 social science. Money plays a major role in our daily lives, from buying pens and notebooks to saving in banks. But have you ever wondered how money evolves or what exactly a bank does? That's exactly what we will learn in this chapter. So get your pens and notebooks ready and let's begin this journey. Before we dive into the details, let me quickly walk you through the important topics that we will cover in this chapter. First, we will begin with the barter system and understand why it failed, followed by the evolution of money from ancient times to today's currency. Then we will explore what money really is, its characteristics, and the various functions it performs in the economy. Next, we'll look at the different types of money, the role it plays, and the problems money can create if misused. After that, we'll move into the world of banks, learning about the concept, origin, and the types of banks, including some special institutions that are not exactly banks but still deals with money. These topics are not only important for your exams but also for understanding how the real world economy works. So, stay with me till the end and let's master this chapter together. From this slide, you can note down the key points that we will cover in the chapter. Let's take a trip back in time, way before wallets, ATMs, and UPI existed. Imagine you are a farmer who grows rice and your neighbor grows sugarcane. One day you want sugarcane and he wants rice. So, in this case, what will you do? Simple, you swap your rice for his sugarcane. That's barter, a system where people exchange goods for goods without using money. But here is the catch. This only works when two people want what the other has. You cannot trade your rice with someone who only wants fish, unless you also happen to have some fish lying around. This shows us something important. No one is completely self-sufficient. Everyone, whether it's a person or village or a country, depends on others for different things. That's how barter started. And believe it or not, this is how international trade also began centuries ago. Just imagine, countries once exchanged silk for spices and gold for tea, all without a single coin. Barter might sound like a fun system. You give rice, get sugarcane. But it wasn't so easy. Let's look at the 4 big problems of barter system. First, lack of double coincidence of wants. Imagine you want fish, but the person with fish wants bananas, and you only have sugarcane. So there will be no deal. Unless both parties want exactly what the other has, no exchange is possible. That's called the double coincidence of wants. And in real life, that rarely happens. The second problem was no common unit of account. If you had to exchange apples for guavas or rice for potatoes, how would you even set the value? 1 apple is equal to 3 guavas, 1 horse for a goat. Confusing, right? There was no fixed way to measure value until money came in to simplify everything. The third problem was indivisibility of goods. You cannot cut an elephant in half just to buy a loaf of bread, isn't it? Some goods are too big, too valuable, and can't be divided easily. But money, it is super flexible. You can pay 10 rupees or 10,000 rupees in coins, notes, or even in paise. Fourth was no store of value. Try saving tomatoes for a year. Not a good idea, isn't it? Most goods spoil over time. That made it really hard to save wealth. But money, it stays safe how exactly it is kept. You can save it in your pocket, your locker, or even better in a bank. So, all these problems led to the failure of barter system and the rise of money. And that's what we will learn about next. We have learned about the barter system. Now let's see how money evolved step by step. Stage 1. We know barter system. At first, people exchanged goods directly. Wheat for rice, cows for tools. This was the age of commodity money, where goods themselves acted as currency. But as we know, it didn't work very well, isn't it? So, what was the second stage? Animal standard. Then came the time when animals, especially goats, were used as money. So, if you were born at the time, instead of carrying wallet or ATM in your pocket, you would have carried goats with you while going to the market. But not all goats were the same. A few were healthy, others were not. Some were black and some were white. And you could not really make sense with half a goat, isn't it? Stage 3. Metallic standard. Next came some shiny things, gold and silver. These metals were rare, valuable and easy to carry. People started accepting them as a reliable form of payment. Coinage. Now things got more official. Governments started maintaining coins from gold and silver bars. Coins were easier to carry, count and trust because they had fixed values and designs. Stage 5. Paper money. Finally, the form of money we are using today, paper money. Lightweight, easy to carry and backed by the government, paper money became the star of the modern economy. From goats to gold to printed notes, the journey of money is quite interesting. We have already discussed about the first stage, barter system. Now let's move to the second stage. So, there was a time when goats were used as money. This was called the animal standard. And let's just say it wasn't the greatest idea. Problem 1. Not all goats were created equal. Some goats were healthy, others sick. Some were white, others black. Imagine trying to pay someone and they say, I don't like this goat. Do you have a healthier one? The whole process became confusing. Too much selecting and rejecting. Problem 2. What if the goats die? During epidemics or diseases, goats would die in large numbers, which meant the money supply literally disappeared. And during breeding seasons, too many goats, that led to too much money, which decreased its value. It's like inflation, but goat inflation. Third problem, you cannot cut a goat. Well, you can, but that's not ideal. Goats are not divisible like coins. What if you wanted to buy something small like bread? You could not give one leg of a goat. So, due to confusion, goat shortages, and the fact that no one wants half a goat, this system broke down and money moved on to the next stage. Now let's talk about metallic standard. So, when people started using gold and silver as money, it seemed like a great idea. But soon they ran into some problems. First problem was how to decide if it was real or fake. Every time someone paid, people had to check if it was real gold or silver. That made transactions slow and kind of stressful. Second problem, it wasn't safe to carry around. Imagine walking through the market with pockets full of gold. Not only was it heavy, but there was always the fear of being robbed. So even though it looked royal, the metallic standard had its problems. That's why people moved on to the next smarter step, coins. Let's discuss about coinage now. So the next step in money's journey was coinage. Gold and silver were melted and minted into coins. This made trade easier and more organized. But even coins had their problems. First problem was coins depended on gold and silver. If there wasn't enough gold or silver available, they could not make more coins. So basically, the supply of money was stuck unless someone found more treasure. Second problem, coins were heavy. As trade grew between towns and countries, people had to carry sacks full of metal coins. Imagine pulling a cart full of coins just to buy something in another city. It was tiring, risky, and not practical at all. So eventually, people said we need something lighter, safer, and easier to carry. That's when paper money entered the scene. Paper money. Let's go back in time and see how paper money actually started. First came something called convertible paper money. In simple words, You could take your paper note to the bank and exchange it for gold or silver. The note was just a slip showing you had real money stored safely somewhere. But later, people stopped asking for gold. They began accepting the paper as real money even though it could not be converted anymore. That's called inconvertible paper money. And that's what we use today. It works because people trust it, not because there is gold behind it. Now, we also swipe cards or write checks. But remember, those are not actual money. They just help us access our money. You cannot use them everywhere like paper money. So, paper money runs on trust, and that trust is what keeps it valuable. So, what exactly is money? According to Geoffrey Crowder, money is anything that people generally accept as a medium of exchange. Simple, right? But here is the important part. It is not just about people liking it. It has to be accepted by everyone, and that too backed by law. This is called general acceptability. If the law says a 500 rupee note is legal money, everyone has to accept it, whether you are buying vegetables or paying at a cinema hall. So, money is anything we all agree to use, and the law gives it that power. Now, let's talk about characteristics of money. Let's talk about what makes money actually work. Its characteristics. Because not everything can be money. Imagine you go to a cinema hall, ask for a ticket, and try to pay with milk or mangoes. Not acceptable, right? So, what are the must-have features of money? First is, money must have general acceptability. This means everyone must agree to accept it in exchange for goods and services. If no one accepts your 10 rupee note, it's just a single piece of paper. Second is, money must have cognizability. That's just a fancy word for easy to recognize. We should be able to look at money and know it is real. We should not get confused. Third is, money must have durability. That's why we do not use milk, eggs, or fish as money. They spoil fast. Money should last so we can store it, save it, and use it later when needed. Fourth is, money must have homogeneity. Means all notes or coins of the same value should look exactly the same. You do not want one 10 rupee note shaped like a book and another like a bedsheet. If money does not match, it causes confusion during transactions. These features help keep our money system smooth, safe, and reliable. Here is something super important to remember. The characteristics of money are not optional. You cannot pick and choose. Money must have all these features together to work properly. Let's continue with the remaining ones. We have already discussed 4 characteristics. Now let's move to the 5th. What does the 5th say? Money must have liquidity. Liquidity means you can use money instantly to buy anything. You do not need to sell it or convert it. Just take it out and spend it. Compare that with land or gold. You first have to sell them, then use the cash. Money is the king of liquidity. Now the 6th, money must have transferability. As the world of trade grows bigger and bigger, money must move quickly and easily. And today, we do not even need to carry cash. We can send money using bank transfers, credit cards, UPI, or online payments. And it doesn't even take time. You can do it in just a few seconds. Isn't it fascinating? The next is, money must have divisibility. Whether you are buying a toffee for 50 paise or a car for 50 lakh, money can be divided into any amount. This was a big problem in the barter system. But with money, no worries. You can break a 1000 rupee note into 500s or hundreds and even coins. The last one is, money must have stability of value. If money keeps losing value, people won't trust it. For example, in Germany during a crisis, prices rose so fast that people stopped accepting their own currency. So a stable value is a must. Otherwise, money stops working as money. And that's why money needs all these characteristics together to stay strong, reliable, and useful in every transaction. Now let's discuss about the functions of money. Money is not just paper or coins. It actually performs 4 powerful functions in our economy. There is even a rhyme to help you remember it. Money is a matter of functions for a medium, a measure, a standard, and a store. Let's break it down. Medium of exchange. Money helps us buy and sell things indirectly. In the barter system, goods were exchanged directly, like rice for sugarcane. But with money, you sell your goods to someone, earn money, and then use that money to buy what you need. It splits the process into two simple steps. The next function is standard of value. Money acts like a measuring stick. It helps us put a price on everything, whether it's a pen, a pizza, or a plot of land. Because of money, we can compare the value of things easily. The next function is standard of deferred payment. Money also helps us deal with payments in the future. Think of loans or buying on credit. You can take something today and pay for it later in money. It keeps things recorded and fair. The next and the last function is store of value. Money holds its value over time. You can earn it today, save it, and use it later. Unlike milk or fruits, it doesn't spoil. But if money loses its value quickly, like in some past economic crises, people may stop trusting it and use gold or land instead. The first two are called primary functions and the last two are secondary. Money also helps in things like reducing wealth gaps when it is used wisely by governments for public benefit. So yes, money is more than just spending and buying power. It's the engine behind the economy. Now let's know about types or classification of money. Money may seem simple, but it actually comes in many forms. Let's start with the two broad categories. First, money of account. This is not actual money you hold in your hand. It's an abstract concept. It helps us measure and record the value of goods and services. Think of it like the office of the Prime Minister. The office always exists, only the person changes. Similarly, money of account stays constant, though the form of money changes. The second type is money proper. This is the real deal, the actual money used in day-to-day life, and it changes over time. What counts as money today may not be money tomorrow. Here are few examples of money proper. First is commodity money like salt or grains. Next, animal money like cattle or cells. Next is metallic money such as coins, and other is paper money like currency notes. But that's not all. Money proper comes in many other types, including legal tender money, non-legal tender money, fiat money, token money, check money, standard money, hot money, dear money, easy money, black money, and high power money. All of these have their own unique role, and we will learn more about them in the next slides. Now let's take a detailed look at the different types of money and their evolution. First is commodity money. Back in the days of barter, things like salt, grain, or pots were used to exchange for other goods. These items were both money proper and money of account, and they were used directly and their value was understood. Next is animal money. At one point, animals like goats were treated as money. They were accepted in trade and also served to measure value. Again, both money proper and money of account. Another is metallic money. Then came gold and silver coins, solid, shiny, and widely accepted. This was the era of metallic money, where value was based on the metal itself. It served as a trusted standard and a practical medium of exchange. Next is paper money. Finally, we got paper money. Light, easy to carry, and safer than metals. Earlier, paper notes could be converted into gold or silver. That was convertible money. But today's money is inconvertible money. It works on trust and government backing. Still, it functions as both money proper and money of account. From grains to goats to rupees, money has come a long way. Let's now look at two important types of money. Those are legal tender money and non-legal tender money. Legal tender money. This is money that the law says must be accepted as payment. If someone refuses it, they are breaking the law. It comes in two forms, limited legal tender like coins which can be used only up to a certain amount. For example, paying 10,000 all in 1 rupee coins not allowed. Unlimited legal tender like currency notes. You can use them for payments for any amount, 100 rupees, 10,000 rupees or more. Both the types are money proper and money of account, real and recorded. Next is non-legal tender money. This kind of money is accepted based on trust, not because of law. For example, checks. People usually accept them, but no one is forced to. So if someone says, sorry, I do not take check, it is completely legal. In short, legal tender is equal to backed by law and cannot be refused, while non-legal tender is equal to based on agreement and can be refused. Simple and super useful to know, isn't it? Let's continue with some more types of money. This may sound a little technical, but do not worry, I will make it simple, okay? Fiat money. This is money that has value because the government says so. There's no gold or silver behind it. Just trust in the law. Like 10 rupees or 500 rupees notes. They are both money proper and money of account. Next is token money. This is money whose material is worth less than its face value. For example, a 5 rupee coin costs much less to produce than 5 rupees. Same with 100 rupees notes. It's called token money because its real value lies in what it represents, not what it is made of. Next is check money. Checks are not legal tender. You can legally refuse them, but they are still widely used and accepted because they are claims on bank deposits. So, even though they are not mass accept money, they help us make smooth payments. Next is standard money. This is the base unit of money. In India, the rupee is the standard money. All other units, like 1 paisa, are measured against it. For example, 100 paisa make up 1 rupee. Now hot money. This is money that moves quickly in and out of a country, especially when there is economic or political trouble. It's called hot because it's nervous, always ready to fly away at the first sign of risk. It's heavily affected by speculation and international conditions. Let's now look at the final set of money types. These are mostly related to government control and financial behavior in the economy. First, dear money. This happens when the central bank, like the Reserve Bank of India, RBI, raises interest rates. As a result, banks reduce both borrowing and lending activities and loans become expensive. That's why it is called dear money, because borrowing becomes costly. This is used to control inflation. Easy or cheap money. This is the opposite. When the central bank lowers interest rates, banks increase borrowing and lending. Loans become cheaper, so people and businesses borrow more easily. This is called the easy money policy, and it helps boost economic activity. Now let's talk about black money. You have heard this word, I think. Black money is not a different kind of currency. It's money that's earned but not reported to the government. For example, someone earns 5 lakh rupees but hides most of it and shows only 1 lakh rupee to avoid tax. That unreported 4 lakh is black money or unaccounted money. It's often linked to tax evasion and corruption. The last is high power money. This is the money that the central bank directly controls. It includes cash in circulation and money held by banks. The RBI can increase or decrease the money supply in the economy using this type. That's why it is called high power money. It gives the RBI strong control over the financial system. So, we have seen how different types of money interacts with banking policies, economy, and even people's honesty. Role of money. Let's now understand the role of money. Why it's so important in an economy. First, money makes exchange easier. It has completely removed the confusion and limitations of the barter system. No more searching for someone who has what you want and wants what you have. With money, you just sell your goods, get paid, and use that money to buy anything else. Simple and smooth. Money supports the price system. In any market-based economy, Prices are based on supply and demand. How much of a good is available and how badly people want it. But none of that works without money. Money gives value to goods, services, and helps us compare prices. Even in government-controlled economies, money plays a key role. In some systems, the government decides what gets produced, how much, and at what price. Even then, the output is measured in terms of money. Because without money, there is no way to calculate cost or plan spending. So whether it's free market or a plain economy, money is at the center of it all. In short, no money, no economy. Now let's discuss about drawbacks of money. Yes, money is powerful and useful, but it also comes with some serious drawbacks. Let's look at a few. Instability of money value. If the value of money falls, which means price rises, people need more money just to buy the same items. That hits poor people the most. And if money suddenly gains value, prices fall, producers suffer losses and cut back on production. That can lead to job losses. Money and economic power. In money-centered economies, the rich can use money to gain more wealth and power. This creates a gap between the rich and the poor, leading to economic inequality. Money and social values. When people become obsessed with money, they often lose sight of values like honesty and fairness. This leads to corruption, injustice, and unethical behavior in society. Impact of black money. When people hide their income and do not pay taxes, it becomes black money. This is a huge problem. The government loses revenue and it affects public service like education, healthcare, and infrastructure. So yes, while money drives the economy, it needs to be used wisely and ethically. What is a bank? Now that we have learned so much about money, it's time to meet its best friend, the bank. A bank is a financial institution that deals with loans and savings. It plays a key role in the economy by collecting savings from people and lending that money to others who need it. So when you deposit your money in a bank, it doesn't just sit there. The bank uses it to give loans to farmers, business owners, students, and consumers. How does a bank earn money? Simple. It charges interest on the loans it gives and for other services it provides. Now here is the trick. The interest it charges borrowers is higher than the interest it pays savers like you. The difference is how the bank earns its profit. So in short, you save, the bank lends, and everyone is benefited, including the bank. Origin of banking. Let's go back in time to understand where banking really began. According to economist Geoffrey Crowder, the early businessmen, gold merchants, and moneylenders were actually the ancestors of modern banks. One of the first proper banks was the Bank of Venice, set up in Italy during the Middle Ages. And that's when the word bank started getting popular. Why did they need banks? Because there were constant wars between the Italian states and they needed funds. So they appointed special officials called Monte to manage the money. Back then, parts of Italy were under German rule, and the word bank evolved differently in each country. Germans said bank, Italians said banco, the French call it banque, and finally in England, it became just bank. Now coming to India, the first bank here was the Bank of Hindustan, way back in 1770. And in Assam, we had the Guwahati Bank, set up in 1926, based entirely on local capital. From Italy to Guwahati, that's quite a journey, isn't it? Kinds and functions of bank. Now let's take a quick look at the different types of banks in our country. There are many kinds of banks, but for now, we'll focus on 6 important ones. First, we have the central bank, which in India is the Reserve Bank of India, the RBI. It controls the money flow in the economy and keeps everything in balance. Then comes the commercial bank. These are the banks we usually visit to open savings accounts, take loans, or withdraw money from ATMs. Next, we have regional rural banks or RRBs, which mainly serve the rural and farming areas. There is also the IDBI, the Industrial Development Bank of India, which helps set up industries by providing long-term finance. Then we have SIDBI, which supports small industries and businesses, very helpful for entrepreneurs. And lastly, there is NABARD, the National Bank for Agriculture and Rural Development. As the name suggests, it works for the development of agriculture and rural areas. And apart from this, there are big international banks too, like the World Bank and Asian Development Bank, but we will get to them later. So we have learned that banks are not just for depositing money, they play a much bigger role in the economy. The functions of the central bank. Let's now talk about one of the most important institutions in a country, the central bank. The central bank is like the head of all other banks. Every bank in the country works according to its instructions. Did you know the world's oldest central bank is the Riksbank of Sweden, established way back in 1656. In India, our central bank is the Reserve Bank of India or RBI. It was set up in 1935. Now let's take a look at the three main functions of the central bank. First, the central bank issues currency. That means it's the only authority in the country that can print money. No other bank has this power. Second, the central bank controls the volume of credit. It keeps a close eye on how much money is flowing through the economy and uses special tools to control loans and lending, mainly through commercial banks. And third, the central bank is the banker's bank. It keeps accounts of all the other banks and helps them in the times of financial trouble, just like a big brother or a guide. So you see, the central bank plays a very crucial role in keeping our country's financial system stable and running smoothly. There are a few more functions of the central bank. Let's continue learning. Apart from issuing currency and controlling credit, it also performs three more important roles. Number 4, the central bank is the financer, advisor, and agent to the government. When the government spends more than it earns, we call this a budget deficit. In such cases, the central bank helps by creating and providing new money. It also advises the government on income policies, tax policies, and trade policies, helping them make better financial decisions. And as the government's agent, it keeps proper records of its income and spendings. Next, the central bank is the custodian of the foreign exchange reserves. Whenever money comes in from exports or foreign investments or goes out of the country, the central bank manages it. It also decides the official rate of exchange, that is, how much Indian currency is worth in comparison to foreign currencies like the dollar or euro. Next is, the central bank works as the clearing house for all the member banks. Just like students settle their group dues, banks also lend and borrow from one another. The central bank keeps track of all these transactions and clears the payments at a national level. So as you can see, the central bank is the backbone of country's financial system, helping the government, the public, and all the banks work smoothly together. Let's now look at two more important functions of the central bank. The central bank has a promotional role to play. It helps in the socio-economic development of the country. By releasing funds to priority sectors such as agriculture, small industries, and rural development that are important for national growth. In India, banks are required to give 40% of their total deposits as loans to these priority sectors. This way, the central bank ensures that important but underdeveloped areas of the economy also grow. Next, the central bank performs miscellaneous functions too. It regularly checks and reviews the country's economic situation. It also provides loans to cooperative banks and other smaller banks. Besides this, it runs welfare funds for educational and social purposes, helping to uplift society in many ways. So we can say that the central bank is not just a regulator, it's also a supporter and promoter of national development. The functions of commercial banks. Now let's understand the functions of commercial banks. Commercial banks are those that provide services to the public, savings, credit, and trade all under the guidance of the central bank. First function, commercial banks mobilize savings. That means they help collect and manage the money people save. There are three main types of savings. First is current savings or deposit. This type of money can be withdrawn anytime by the account holder. Next is fixed saving or time deposit. This money cannot be withdrawn instantly. The depositor must inform the bank in advance before taking it out. Third is savings deposit. Here, a part of the money can be taken out when needed, but the remaining part can only be withdrawn with the bank's permission. In India, back in 2001, only 36% of the population had bank accounts. By 2011, this increased to 59%, and by 2014, over 210 million Indians had bank accounts. This number is still growing, showing how important commercial banks are in our lives. Let's look at a few more important functions of commercial banks. Commercial banks offer loans. Banks provide loans to farmers, artisans, industrialists, thelawalas, rickshawalas, and others. When people use these loans properly, it improves their economic condition. However, most commercial banks do not offer long-term loans because giving money for a long period means the bank cannot use those savings for others. This can be risky. If many depositors ask for their money back, the bank might not be able to pay them. This leads to people losing trust in the bank, and it can even result in bankruptcy. Commercial banks can create credit money. This means they can generate money in the economy through credit or loans. It all begins with deposits. When people deposit money, it is called a primary or passive deposit. The bank is called passive here because it does not do anything actively. The depositor takes the first step. But then, banks keep a smaller portion of the deposits and give the rest out as loans. These loans are called active or derivative deposits because they are created by the banks. So the moment banks start lending money, the process of credit creation begins. Example of credit creation. Let's now understand how credit creation works with a simple example. A person deposits 1000 rupees in bank 1. This is called the primary deposit. The bank keeps 200 as reserve, means 20%, and lends the remaining 800. The borrower then spends 800 and it gets deposited in bank 2. Bank 2 keeps 160 rupees, again 20%, and lends the remaining 640 rupees. 640 rupees is then deposited in bank 3. Bank 3 keeps 128 rupees and lends the remaining 512 rupees. And this cycle continues from one bank to another. What is the result of this process? The total deposits created will be 5000 rupees. This means that with just an initial deposit of 1000 rupees, the banking system creates 5000 in total deposits. This is known as the credit creation process, which happens because of the money multiplier effect. Finally, commercial banks also perform miscellaneous functions. They keep valuable ornaments and documents safe in lockers and sometimes even act as a trustee for their customers. The Industrial Development Bank of India, IDBI. The Industrial Development Bank of India, or IDBI, was established in 1964. Its main functions are providing financial assistance to industries. Second is developing institutions related to industrial growth. IDBI offers both directly and indirect loans to industries. Indirectly, it supports institutions such as State Financial Corporation, Industrial Development Corporation, and commercial banks. These institutions then lend the funds to industries. Another important role of IDBI is offering concessional loans to industries in backward regions. It also supports entrepreneurship through various training programs. Thus, IDBI plays a major role in boosting industrial development across India. Regional Rural Banks, RRBs. Regional Rural Banks or RRBs were first set up in 1975. By the year 2014, the number of RRBs in India had grown to 57. Let's look at their functions. To provide loans at low rates of interest to villagers and help them escape the control of private moneylenders who charges very high interest rates. To mobilize rural savings and invest these funds to productive rural activities, supporting the local economy. RRBs play a vital role in rural development and ensuring financial inclusion in India's villages. NABARD, National Bank for Agriculture and Rural Development. The National Bank for Agriculture and Rural Development, popularly known as NABARD, was established in 1982. It took over the functions of the Reserve Bank of India related to rural credit. Let's look at the main functions of NABARD. NABARD is the apex financial institution for all rural investment and production related institutions. It streamlines the loan process, monitors and evaluates rural development schemes, and also organizes training programs for beneficiaries. NABARD coordinates various rural development schemes run by the central government, state government, the RBI, and other agencies. In short, NABARD plays a crucial role in strengthening rural India through finance, training, and development support. SIDBI, Small Industries Development Bank of India. The Small Industries Development Bank of India, or SIDBI, was established following a bill passed in 1989, and it began operations in 1990. Its headquarters is located in Lucknow. Let's explore the main function of SIDBI to promote modernization and encourage the use of improved technology in small-scale industries. Next is to create markets for the products produced by these small industries. Third is to generate more employment opportunities in semi-urban areas and to reduce migration from these areas to towns and cities. Fourth and the last is to provide financial assistance to institutions like state financial corporations, industrial corporations, commercial banks, cooperative banks, and regional rural banks so they can extend loans to small industries. SIDBI plays a vital role in supporting and strengthening small industries, which are the backbone of India's economy. Non-banking financial institutions, NBFIs. Non-banking financial institutions, or NBFIs, function somewhat like banks. They collect savings from people and provide loans to others. But there are two important differences between banks and NBFIs. In banks, depositors can withdraw money using checks, but this is not possible in NBFIs. Banks offer deposit insurance schemes to protect depositors' money. NBFIs do not provide this kind of insurance. To operate legally, NBFIs must be registered with the Reserve Bank of India. However, many unregistered NBFIs have been found to cheat depositors, often vanishing overnight with their money. Some well-known non-banking financial companies are Bajaj Finance Limited, HDFC Limited, Tooth Finance, Mahindra and Mahindra Financial Services, L&T Finance Holdings, etc. So while NBFIs play a vital role in the financial sector, it's very important to check whether they are RBI registered before investing. And with that, we come to the end of our journey through the fascinating world of money and banking. From the early days of barter to the emergence of digital finance, we have explored the evolution of money, the rise of banking systems, and the critical roles played by institutions like commercial banks, IDBI, and NABARD in shaping our economy. We hope you now have a better understanding of how money moves, how banks function, and how rural and industrial development are supported across the country. If you found this video informative, do not forget to like, share, and subscribe our YouTube channel, Gyanar Batchora. Thank you for watching the full video. Let's meet in the next lesson.